All right, so in this video, I'm going to talk a little bit about yield curves and how that relates to the federal funds rate and so forth. So let's talk first about what a yield curve is. So a yield curve is looking at a particular borrower and the rates that borrower would have to pay for loans of different maturity, all starting today. So in other words, if I am borrowing today for 3 months or 5 months or a year or 5 years or 25 years or 30 years, looking at what those loans would look like. So for a yield curve, when you see the term yield curve used, oftentimes what we're referring to is a yield curve looking at Treasury securities, so loans associated with the federal government. So if I look at a yield curve with Treasury securities, basically what I'm looking at is for the loans that the government has that are different maturities, what are the interest rates or yields on the loans for those different maturities? Now, if you think about some of the things I've talked about previously, the Federal Reserve changes the federal funds rate, and the federal funds rate is sort of their target, and they will engage in those open market operations to try to get interest rates to line up with their target. So, how does that relate to the yield curve? Well, that federal funds rate basically is very much linked to shorter term rates. So when the Federal Reserve says that they are going to raise the Fed funds rate, what that basically means they're trying to get the shorter term rates to have higher interest rates. And if they're going to lower the Fed funds rate, it means they're trying to get shorter term rates to have lower interest rates. And so it will actually affect the shape of the yield curve. It'll change where those short term rates are when you plot that on a graph, which is the yield curve. Now, for a normal yield curve, basically, typically what you have is short-term rates are lower than long-term rates. And the reason for that is a couple fold. One, if you were perhaps thinking about lending money to me, you look at my financial position, you think about lending me money for the next 3 months, you think, okay, I know the financial position that Dr. Wiley has, and I don't think it's going to change drastically in the next 3 months. You assess the risk and you quote an interest rate. If you're thinking about lending me money for the next 30 years, that's going to look a little bit different when you assess it because you're thinking, well, over 30 years, lots of things could change. And therefore, if lots of things could change, then perhaps you ought to charge a somewhat higher interest rate because you're not quite sure what things could look like over the next 30 years. My financial position could change. And therefore, you would want to have a higher interest rate over that longer term to compensate for the unknowns, the uncertainty that you have there. So it's not uncommon that just from a risk standpoint, typically you would sort of expect that shorter term loans would have lower rates than longer term loans. Now, we also have some other reasons why shorter term loans would have potentially lower rates than longer term loans. One possible scenario is if we have a situation in which inflation is pretty stable now, but we're expecting inflation to be higher later, then for a short-term loan, we kind of price in a lower level of inflation when quoting the rate. But for that longer-term loan, we price in the higher expected inflation, and that leads to that higher rate. And that would mean that the shorter-term rates are lower than the longer-term rates. Another possibility would be economic growth. So if we expected a lot of economic growth going forward, that means we're going to have more people competing to borrow the same dollars to invest it and spend because of all this growth. Everybody's trying to grow and expand. And so as a result of that, if I had a lot of expected economic growth, it would tend to push those longer term rates up, basically because of the fact that we'd be expecting more competition for those funds long term. Okay. So all of those are reasons why basically short-term rates would be expected to be ultimately lower than long-term rates. And so if I plot that, basically what I get is a yield curve. So for the yield curve, what we have here is this is plotting the yield curve, and I have the time to maturity on the x-axis. I have the interest rates on the y-axis. What this is showing is for loans of short maturity, the rates are lower than for loans of a longer maturity. And the longer the maturity gets, the higher the rate gets. Okay? And so that is the idea behind the yield curve, or basically, or at least a normal yield curve. Yeah. If we come back to inverted yield curves, so for the inverted yield curve, basically what you could have is a situation in which there is high current interest rates and inflation. And so basically if interest rates are high at the moment because inflation is really high at the moment, but we don't expect inflation to be high going forward, then in that case, basically we're quoting in a high level of inflation in the short-term rates, or we're quoting a more, or expecting to have a lower level of inflation in the long-term rates. And as a result, you could have a situation in which the short-term rates are actually higher than the long-term, possibly due to what's going on with inflation at the time. And there could that could involve sort of an expectation, sort of a gradual decline in the inflation over time, things like that, or perhaps a gradual decline in the economy over time. So if we're expecting maybe a little bit less economic growth going forward, then that would also fit with kind of an inverted curve. So in other words, I got lots of demand for the money right now. The interest rates are high for short term, but I'm kind of thinking, if it looks like, the economy is not going to hold at that level of growth, and market participants are basically saying, but for a longer term loan, we'll charge this rate here because we're not expecting this level of demand for currency or money to hold over that full period there. And so sometimes you'll see an inverted curve before a recession. It's not a perfect predictor. There's no perfect predictor of a recession. But if you do see an inverted curve is when the short-term rates are higher than long-term. Normally, you wouldn't expect that. Normally, you'd expect the normal curve, which is why it is called normal, right? Where short-term rates are lower than long-term. But if I have short-term rates higher than long-term, then basically what's kind of happening here is that risk premium for time, for the longer time, it's still there, but it's being swamped out by these other factors of expectation of perhaps some economic decline, expectation of drops in inflation, things of that nature. So recession, what have you. Those are overwhelming that, and basically they are leading to essentially the inverted curve. And so from that perspective, basically what you would get is a curve that looks something like this, okay, where short-term rates are higher than the longer-term rates. And that's the idea behind the inverted curve. So the short-term rates are higher than the long-term. And if you tie this back to Federal Reserve policy, if the Federal Reserve has raised their Fed funds rate, and they're engaging in market activities to do so, that's going to tend to shift the short-term rates more than the long-term rates. And that could cause things to go from a normal curve to an inverted, keeping in mind the long-term rates may not have changed that much. I mean, they do change. Okay, so don't assume from this graph the long-term rates don't change. But long-term rates can change. They don't change typically nearly as much as the short-term ones do. And so if the Federal Reserve was basically trying to contract or pull money out of the economy to deal with the inflation, it would raise the rates, and those Fed fund rates that they raise typically is going to be more of the short term, and they could pull it into essentially that inverted curve. And so when you see an inverted curve, it does kind of suggest that possibly the Federal Reserve is raising rates to combat inflation and trying to slow down the economy. And hey, they just might succeed. We might wind up with a recession out of that. Now, ideally, the Federal Reserve will try to pull off what is called a soft landing, where we actually raise the rates just enough to kind of tamp down the inflation, but not so much to stall out the economy and trigger a recession. That's great in theory, much harder to pull off in practice, I would argue. But still, if you see an inverted curve, that would be something to be mindful of. At least it tells you the Federal Reserve is trying to take money out of the economy, or perhaps people's expectations about future growth are not looking as good relative to current economic activity, things of that nature. And so that would be a good thing to kind of keep in mind when evaluating yield curves. So again, this bottom curve is the normal yield curve. You'll see that more typically. If you see this, something that looks sort of generally like this top one, that's the inverted yield curve. And that might be an indication that there might be some interesting economic challenges. All right, hopefully this video has been helpful. Thank you so much for watching, and have a great day.